Think about all the smart devices around you right now. Your car, your phone, maybe even your thermostat.
Yeah, they're everywhere.
What makes them tick? What makes them smart? Well, often it's semiconductors, those hidden heroes.
Absolutely. The brains behind the operation.
And today we're doing a deep dive into NXP Semiconductors. They're a huge player. Their tech is in billions of devices.
Major force, yeah.
So our mission is to unpack their latest Q2 2025 results, look at their strategy, and figure out what it all means, for tech and how we understand companies.
Yeah.
We're pulling the key bits from their reports, their presentations, so you get the essential insights.
Sounds good. And NXP just dropped those second quarter results.
They did.
And, the headline numbers look okay, maybe even good in places, but the real story, it's a bit more complex when you dig in.
Right. That nuanced view is so important, especially when their CEO, Kurt Sievers, talks about an emerging cyclical improvement and strength from their company-specific growth drivers. I mean, on the surface, revenue beat expectations, right? $2.93 billion for Q2. That sounds positive.
It does, sequentially from Q1. It's up.
But you mentioned complexity. How do we square that emerging improvement with the fact that year-over-year revenue is actually down 6%? What's really going on there?
That's exactly the question, isn't it? That 6% year-over-year dip tells us that, while things might be looking up quarter to quarter, the broader market compared to last year is still facing some challenges, some headwinds.
Okay.
So when NXP says emerging cyclical improvement, they're likely pointing to, a positive trend within that tougher environment. Maybe demand is stabilizing or certain segments are starting to pick up faster.
Gotcha.
And critically, to really get it, you have to understand their use of non-GAAP numbers. GAAP is the standard, sure.
Generally accepted accounting principles, yeah.
Right. But non-GAAP, it excludes certain things, often non-cash stuff like stock compensation or amortization from acquisitions, maybe one-off restructuring costs.
Things that can kind of cloud the picture of the core operation.
Exactly. It strips out some of that noise. So for you, the learner, looking at non-GAAP, give you a clearer view of the ongoing health, the real operational performance. It's often what management themselves are focusing on day to day.
That makes sense. So with that context, let's look at the actual Q2 numbers. Revenue, $2.93 billion above their midpoint guidance.
Yep.
And looking at those non-GAAP figures management likes, gross margin ticked up to 56.5% from 56.1% in Q1.
Slight improvement.
Operating margin also up just a hair, 32.0% from 31.9%. And non-GAAP EPS, earnings per share, $2.72, up from $2.64.
So sequentially, things look better on the operational side.
Definitely. And cash flow from operations was strong, $779 million. That led to a non-GAAP free cash flow of $696 million. Solid numbers.
And connecting that back, these non-GAAP figures, they're not just for show. They're like the company's internal compass.
How so?
Well, management uses these numbers, that gross margin, operating margin, free cash flow, to decide where to spend on R&D, new products, how much capital to allocate where, what the budgets look like.
Oh.
So for you, it's really a peek into how NXP itself sees its health, where they're actually putting their money and focus. It's not just the external message.
Interesting perspective.
Yeah.
And beyond the operations, something that really jumped out, especially for shareholders, was the capital return.
Oh, yeah. That was significant.
They gave back $461 million to shareholders in Q2.
Yeah.
That's like, 66% of their non-GAAP free cash flow?
A huge chunk.
Yeah. $204 million in share buybacks, $257 million in dividends. That really signals confidence, doesn't it? And a commitment to returning cash.
Absolutely. When a company returns that much cash, it says they feel good about their financial position and future cash generation.
Okay, so shifting from the financials, NXP also made some really big strategic moves in Q2. Seems like a lot happening around automotive and this intelligent systems at the edge idea.
Definitely. That was a major theme. Automotive innovation was front and center.
What specifically?
Well, first, on May 8th, they announced their third-gen imaging radar processors, the S32R47. These are built on 16-nanometer FinFET tech.
Okay, cutting-edge stuff. What does that mean in practice?
It means tiny transistors packed densely, using a 3D designed FinFET for better efficiency and less power leakage. The upshot, up to twice the processing power.
Twice? Wow.
Yeah. Which is critical for handling all the data needed for advanced driver assist systems, level 2+ and years, even up to level 4 autonomous driving. This really shores up their leadership in automotive radar.
Makes sense. What else?
Then, mid-June, they announced a partnership with Rimac Technology. You know, the high-performance EV guys?
Oh yeah, Rimac. Cool.
They're co-developing a software-defined vehicle, or SDV architecture. This is a huge shift in the industry, moving car functions from hardware to software control.
Like updates on your phone, but for your car.
Pretty much. And it uses NXP's S32E2 processors for, and this is key, high-performance deterministic real-time domain and zonal control.
Okay, break that down. Deterministic real-time.
Means critical functions, braking, steering happen instantly, reliably, no lag. Super important for safety.
Obviously. And zonal control.
Managing specific areas or zones of the car independently makes it more precise, modular, smarter control.
Got it.
And then just a few days later, June 17th, they finalized the acquisition of TT Tech Auto.
Ah, I saw that. They're big in safety systems, right?
Exactly. A leader in safety-critical systems and middleware specifically for these software-defined vehicles. So it all ties together.
It really does paint a picture of them doubling down on automotive and this whole SDV concept. It feels like the car is turning into a giant computer on wheels. Is that fair?
That's a really good way to put it, yeah. That's essentially NXP's big strategic bet, becoming the core silicon and software platform for this intelligent edge. And automotive is just, well, the prime example right now.
So the gamble is that this shift to software-defined architectures is real and lasting.
Precisely. They're banking on it. And their confidence comes from their existing leadership, their close ties with car makers, and now bringing crucial software know-how in-house with acquisitions like TT Tech Auto.
But why is this intelligent edge so critical? What does that term really capture?
It's where the computing, the sensing, the connectivity all come together right at the source of the data. Think smart cars, smart factories. It enables faster decisions, more sophisticated features because the thinking happens locally, not just in the cloud.
Right. Less latency, more capability.
Exactly. But it's also, you know, a super competitive space. You've got Texas Instruments, STMicro, and Infineon all fighting for share.
So NXP's moves with the advanced radar chips, the TT Tech buy, it's about carving out a strong position.
Yeah, gaining an edge,
Yeah.
pun intended, in specific high-value parts of this automotive transformation.
So we can see that focus in their Q2 end market results, too.
Sure.
Automotive revenue, $1.729 billion. That was up 3% from Q1, flat year on year. Pretty solid, right?
Very solid, especially given all the innovation investment. Flat year on year in this climate isn't bad.
Then industrial and IoT, $546 million. That was up 7% quarter on quarter, which is a good sign,
Yeah, suggests some recovery there.
but still down 11% compared to last year. Mobile was $331 million, down a bit both Q and Q and Y and Y.
Mobile continues to be a bit soft for them.
And then communication infrastructure, another $320 million, up slightly from Q1, but down a hefty 27% year on year.
Oof, yeah. That segment clearly faces some ongoing headwinds, maybe slower 5G rollouts or other shifts impacting demand there.
So looking longer term, how does NXP see this playing out? What's their big picture vision?
Well, their investor presentation lays it out pretty clearly. They're targeting doubling their non-GAAP EPS by 2030 or beyond.
Ambitious.
Very. They're also aiming for high single-digit organic revenue growth and pushing gross margins above 60%.
And how do they get there?
They point to key drivers, that S32 platform for software-defined vehicles, intelligent edge systems more broadly, and their hybrid manufacturing strategy. It shows they're really aligning with where the whole semiconductor market is heading. You know, that estimated $1.3 trillion market where automotive and industrial are really expected to lead the growth.
They're positioning themselves for those big trends.
Exactly. It's a clear signal of intent.
I also noticed they're talking a lot about sustainability. How serious is that? Is it just talk or?
No, it seems pretty baked into their strategy. It's not just PR. Their main goal is carbon neutral by 2035.
That's a big one.
It is. And nearer term, by 2027, they want a 35% cut in carbon emissions, 50% renewable electricity, 60% wastewater recycling.
Okay, specific targets.
Right. And what's notable is their strong ratings from groups like MSCI, Sustainalytics, CDP, S&P Global. They consistently get low risk or strong performance scores.
So it's translating into measurable progress?
It appears so. And in this industry, you know, resource management, energy efficiency, it's not just good for the planet. It can save costs and appeal to investors and customers who care about supply chains. It's becoming a competitive factor.
Definitely. Okay, so they had a decent Q2, lots of strategic moves.
Yeah.
What are they projecting for next quarter? Q3 2025. Is that emerging cyclical improvement expected to pick up steam?
The guidance certainly suggests they think so. They're projecting continued positive momentum.
What are the numbers?
For Q3, they expect total revenue between $3.05 billion and $3.25 billion. The midpoint there, $3.15 billion, means sequential growth of anywhere from 4% to 11%. That's pretty strong.
Okay, yeah.
Non-GAAP gross margin expected between 56.5% and 57.5%. Operating margin between 32.7% and 34.6%. And non-GAAP EPS between $2.89 and $3.30.
So across the board, they're guiding higher than Q2.
Correct. It suggests management feels their growth drivers are kicking in, and maybe that market recovery is starting to materialize more clearly.
Now, this is where it gets really interesting, especially for you, the listener, trying to figure out market perception. There's a bit of a split, isn't there, between Wall Street analysts and one of our sources, Guru Focus, on NXP's valuation.
Yeah, it's a fascinating contrast. Really highlights how different approaches can lead to different conclusions.
Tell us about it.
Okay, so you look at Wall Street analysts based on 29 of them, the average price target for NXP is around $247.15.
Which, compared to the price around $228, implies
about an 8.3% upside. And the consensus rating is outperform. So generally positive sentiment there, looking at near-term prospects.
Okay, but then Guru Focus.
Guru Focus uses their own model, the GF value estimate, and that puts NXP's fair value at $202.76.
Whoa, that's quite a bit lower.
Yeah, it suggests over an 11% downside from the current price. They basically see it as overvalued based on their analysis of historical multiples and growth.
So why the big difference?
It often comes down to methodology and focus. Wall Street might weigh recent news, guidance, and short-term catalysts more heavily. Models like GF value often lean more on historical performance, intrinsic value calculations, maybe a longer time horizon.
Different lenses, different views.
Exactly. And for you, it's a great reminder that no single number tells the whole story. You need to understand the why behind the valuation.
Absolutely. And speaking of metrics to watch, Guru Focus flagged high inventory levels back in Q1, 169 days. How did that look in Q2? Because inventory can be a tricky thing in semis.
That's a really sharp point, yeah. Inventory is crucial. The good news is it improved in Q2. Their days of inventory, or DIO, came down to 158 days from 169.
Okay, moving in the right direction.
Right. And also, their channel inventory, the stuff sitting with distributors, was reported at 9 weeks in Q2. That's down from 11 weeks they mentioned at their 2024 Investor Day.
So less product sitting unsold.
Seems like it. High inventory can signal slowing demand, right? Might lead to price cuts down the line. So seeing these numbers trend down is positive. It suggests they're managing it better and maybe demand is firming up.
It's that balancing act.
Always. You need enough supply, but not so much you get stuck with it if demand doesn't meet expectations. The Q2 improvement suggests they're navigating that balance better.
Okay, so summing up, NXP navigating a pretty complex market, delivering solid Q2 operational results, making aggressive moves in key growth areas like automotive.
Right, especially with software-defined vehicles.
Managing inventory down, returning cash to shareholders. Seems like a company really positioning itself for the future.
Yeah, this deep dive really shows, I think, just how complex the semiconductor world is, but also how NXP is trying to place itself right at the heart of these massive trends, SDVs, the intelligent edge.
And that valuation difference is a good reminder to keep digging.
Absolutely. It prompts you, the listener, to do your own homework, form your own view, because different valid approaches exist.
Indeed. So for you, our listener, maybe a final thought to chew on. As NXP pushes hard into this intelligent edge, especially making cars into these powerful computers, how does that change things? Not just NXP's revenue, but what even is car in 5 or 10 years? Or smart home? What new things become possible because of the tech they're building right now? What does it unlock for your future?